Hey everyone, in this video, I'm going to bring you one Cathie Wood dividend stock that passive income investors can buy for 2024 and beyond. I know what you're thinking. Wait a minute, Cathie Wood dividend stocks? Doesn't she only invest in these innovative growth stocks? You'd be surprised to see that Cathie Wood does own some dividend stocks. Of course, the majority of her portfolio is in those innovative growth stocks, but she has included a few dividend stocks in her ARK portfolios. And in this video, I'm going to share with you one of my favorite Cathie Wood dividend stocks for 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
And the dividend stock is John Deere. You could see Cathie Wood has 0.27% weighting of Deere in her portfolios of Cathie's ARK. You can see across her portfolio, she has two positions in Deere. That means Cathie Wood owns it in two of her ARK portfolios. So now let me share with you why I like Deere stock. Starting with the company's excellent revenue growth over the last several years, you can see from 2015 up to the most recent trailing 12-month update, Deere's revenue has increased from 36 billion all the way up to 60 billion. The company has benefited in the last 2 years as inflation has raged on. It has increased commodity prices, which has made Deere's equipment more desirable for farmers that want to increase their harvest, increase efficiency, and the higher commodity prices is bringing in enough revenue and cash flow for Deere's clients to justify an upgrade in technology. Additionally, Deere has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses as we see in this example, and profits grow by a larger magnitude than the increase in sales. That being said, you can see Deere has increased its operating profit margin from about 15% in 2015 all the way up to 24.22% in the most recent trailing 12-month update. Now, Deere may not have the most attractive dividend yield at 1.33%, but given the company's revenue growth and profit growth, the company has an excellent chance to increase its dividend per share over the next 5 and 10-year periods. Let me share with you the excellent earnings growth that Deere has demonstrated. So this is Deere's normalized diluted earnings per share over the trailing 12-month period. You can see how it's grown from about $9 per share all the way up to $34.66 per share. The bulk of that increase coming in the last 2 or 3 years. That's a surge of more than triple earnings per share growth for Deere in the last 2 to 3 years. Now, I want to caution dividend stock investors not to expect this to continue for Deere. This was an unrealistic unprecedented surge for Deere in the near term because of those macroeconomic factors I discussed earlier, with inflation helping boost commodity prices and helping Deere's clients. In fact, Deere itself said as much. In its fiscal year 2024 forecast, Deere said its net income will be $7.75 billion to $8.25 billion. And if you compare that $8 billion net income forecast at the midpoint for 2024 with Deere's fiscal year 2023 net income was $10.166 billion. So net income is expected to drop by about $2 billion for Deere. Now that's okay, because like I showed you, the company's profitability more than tripled in the last few years. A bit of a decrease is understandable. Let's look at what the analysts think. So according to the analysts that follow Deere stock, they say that in the quarter that will end October 2024, Deere's revenue will fall by 13.8% and earnings per share will fall by 18.5%. Okay, so that's what I've been talking about. The company experienced a surge in the last few years, and this is a bit of a pullback. That's all right. I'll take that. Company more than tripling its earnings and then experiencing an 18.5% pullback. That's okay, especially because analysts expect Deere to turn things around after that. Revenue is expected to be relatively flat and earnings to grow about 2% in 2025. And then in 2026, earnings per share is expected to grow by 3.8%. So this decrease in earnings per share is a one-off event for 2024, according to analyst estimates. And then Deere will continue growing earnings per share again. And that's great news, considering that Deere's earnings per share has already exploded by so much. So that's really good news. And the last reason why I'll talk about Deere as an excellent dividend stock to buy is the attractive valuation. Deere is trading at a forward price to earnings ratio of 13.24, which is a relatively cheap valuation. And remember, when you're looking at a forward price to earnings ratio, it's considering the earnings per share that are expected in the next 4 quarters. And so this price to earnings ratio is already incorporating the fact that Deere's earnings per share are going to decrease over the next few quarters. So it's already incorporating that, and then there's going to be a rebound according to estimates. And so you're getting the stock at a fair or relatively cheap valuation, I should say, that's incorporating the diminished prospects for the next few quarters. And then beyond that, you're getting the stock that's been able to grow operating profitability, grow earnings per share, grow revenue, and all the excellent things that Deere has been able to do. You're getting that stock at a relatively cheap valuation. So for all those reasons, I'm recommending Deere as an excellent dividend stock to buy. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.